For decades, gold and silver were considered the final line of financial defense. The assets investors rushed into when currencies weakened, when markets collapsed, when geopolitical tensions escalated. But suddenly, something unexpected happened. Gold began to fall, silver followed, and the decline did not behave like a normal correction. Prices started breaking levels that had held for months. Liquidity began disappearing from the market, and the selling pressure spread across multiple asset classes at the same time, which raises a question very few investors are asking right now. Is this simply volatility, or is the financial system quietly entering the kind of liquidity event that historically precedes much larger market dislocations? Because if this is not just a correction, then what we are witnessing today may only be the beginning, and the real move has not even started yet. Now, before moving forward, welcome to Boring Currency FX, the place where complex global financial events are broken down into clear strategic insights. And if someone watching this video has already crossed the age of 50, then they understand something younger investors often forget. Real wealth is built through patience, discipline, and staying informed. So if you appreciate calm, analytical breakdowns of global markets, consider subscribing to the channel. It helps this research reach more serious viewers like you. And one more thing before we continue. Tell us in the comments, which country are you watching from today? Because this story may affect investors everywhere. In global finance, there are moments when markets move slowly, and then there are moments when something suddenly changes the entire structure of the system. This situation with gold and silver appears to be one of those moments. For months, investors across the world had been watching the precious metals market closely. Gold had climbed steadily, supported by central bank buying, geopolitical tensions, and rising concerns about global debt. Silver followed the same direction, but with much greater speed and volatility. In many ways, silver had become the aggressive counterpart to gold. When gold moved up, silver often moved faster. When confidence in the financial system weakened, investors rushed into both metals. But markets rarely move in straight lines. In the days leading up to the sudden crash, something unusual began to happen. Gold approached a major resistance level that many professional traders were watching carefully. The price had been climbing for weeks, and optimism was building across the market. Many analysts believed that if gold broke through that resistance, it could open the door to another historic rally. But resistance levels exist for a reason. When the price reached that critical level, instead of continuing upward, selling pressure began to appear. At first, it looked like a normal rejection. Financial markets reject resistance all the time. Prices pull back slightly, investors take profits, and then the market stabilizes. However, this time, the reaction did not follow the usual pattern. Instead of stabilizing, gold continued falling. At the same time, silver began dropping even faster. Within hours, prices started breaking through levels that traders had previously considered strong support zones. This behavior immediately raised concern among experienced market observers. Professional traders understand that when a market breaks a support level and fails to recover quickly, it often signals that something deeper is happening beneath the surface. Support levels represent areas where buyers previously stepped in to defend the price. When those levels fail, it suggests that the balance between buyers and sellers has changed. And in the precious metals market, that balance can shift very quickly. For many months, bullish sentiment had been building around gold and silver. Investors believed inflation risks remained high. Geopolitical tensions were increasing, and global debt levels were reaching historic extremes. In that environment, precious metals were viewed as a form of financial insurance. But markets do not move based only on long-term fundamentals. Short-term price movements are often driven by something far more mechanical. Positioning, large hedge funds, institutional traders, and banks frequently use leverage when trading metals futures. Leverage allows them to control large positions with relatively small amounts of capital. While leverage increases potential profits during rallies, it also creates risk during downturns. When prices begin falling rapidly, leverage traders can face margin calls. Brokers demand additional capital to maintain positions. If that capital cannot be provided quickly, positions are forced to close, and when positions close, the assets are sold automatically. This process creates a chain reaction. One forced sale pushes the price lower. That lower price triggers another margin call somewhere else. That second margin call forces another sale. Each sale creates the conditions for the next. This is known as a liquidation cascade. In many historical market crashes, this mechanical process, not investor sentiment, has been responsible for the most violent price moves. For the average observer watching prices on a screen, it can appear as if investors suddenly lost faith in the asset itself. But in reality, the selling often has nothing to do with belief or strategy. It is simply the mathematics of leverage. As the selling pressure intensified in the gold and silver markets, experienced analysts began examining whether this was simply a technical correction or the early stage of a much larger liquidity event. Liquidity events occur when the financial system suddenly demands cash. During these moments, investors sell whatever assets they can in order to raise liquidity. Stocks fall, bonds fall, commodities fall. Even traditional safe haven assets like gold can temporarily decline during these phases. History shows that when liquidity stress enters the system, correlations between assets increase dramatically. Markets that normally move independently begin falling together. That pattern appeared to be emerging again. At the same time, geopolitical tensions across key regions of the world were increasing rather than decreasing. Energy supply routes were facing disruption, and global trade risks were rising. Under normal circumstances, such developments would strengthen the case for higher precious metal prices. Yet the market was moving in the opposite direction. This contradiction created a puzzling situation. On one side stood the long-term fundamentals that traditionally support gold and silver. On the other side stood the short-term price action showing aggressive selling pressure. When these two forces diverge, analysts must look deeper into the structure of the market. Because sometimes the most important signals in finance are not the headlines or the political events. Sometimes the most important signals appear in the behavior of price itself. And at this moment, the behavior of gold and silver was sending a message that experienced investors could not ignore. The question now facing the global market was simple, but extremely serious. Was this merely a temporary liquidation event that would eventually stabilize? Or was the precious metals market entering the early stage of a much larger financial adjustment? That answer would begin to emerge as analysts started examining what was happening behind the scenes of the financial system itself, something that had quietly appeared in one of the most important markets in global finance, the market where banks go when they urgently need cash. In the case of gold and silver, that trigger was not simply fear, speculation, or investor emotion, it was liquidity. Liquidity is one of the most powerful forces in financial markets, yet it is also one of the least understood by the general public. Liquidity simply refers to the availability of cash within the system. When liquidity is abundant, markets rise easily. Investors have access to capital, banks lend freely, and assets find buyers quickly. But when liquidity suddenly tightens, the entire financial environment begins to change. In a liquidity shortage, the priority of investors shifts immediately. Profits no longer matter as much. Long-term strategies become less important. The only thing that matters is access to cash. And when that shift happens, markets begin to behave very differently. For months leading up to the recent precious metals sell-off, many large financial institutions had built substantial leverage positions. Hedge funds were active in metals futures. Commodity funds were increasing their exposure. Some institutional traders were positioning themselves for a continued rally in gold and silver. On the surface, the logic made sense. Global debt levels were rising, inflation risks remained present, geopolitical tensions were growing in several important regions. Historically, these conditions have often supported precious metals, but leverage changes everything. A trader using leverage does not truly control their position. The broker controls it. As long as prices move in the expected direction, the system works smoothly. But when prices begin to move against those positions, the broker steps in. This is where the concept of a margin call becomes critical. When leveraged positions begin losing value, brokers require traders to deposit additional capital to maintain those positions. If the trader cannot provide that capital immediately, the broker liquidates the position automatically. The liquidation is not a decision. It is a rule. Once that rule begins activating across multiple institutions, selling pressure accelerates rapidly. This is exactly how market cascades form. The first wave of selling pushes prices lower. Those lower prices trigger margin calls for another group of traders. Their positions are then liquidated, which pushes prices even further down. Each step intensifies the pressure on the system. Within a short period of time, the selling becomes self-reinforcing. Gold began to fall. Silver began falling faster. And as the metals declined, analysts started noticing something unusual happening across other markets as well. Stocks were weakening, certain commodity contracts were under pressure. Even traditionally stable asset classes were showing signs of stress. When experienced financial observers see multiple markets declining at the same time, one explanation often rises above the others: liquidity demand. In other words, institutions were not necessarily abandoning gold and silver because they believed the long-term story had changed. They were selling because they needed cash, and that need for cash can come from many places. Large funds may be covering losses in other markets. Banks may be adjusting their balance sheets. Institutions may be responding to tightening credit conditions. Whatever the reason, the effect is the same. Assets are sold not because they are weak, but because they are liquid. Gold and silver fall directly into this category. They are among the most liquid assets in global markets. Positions can be closed quickly, contracts can be sold easily, and the transactions can raise cash almost immediately. During liquidity stress, that makes them prime targets for liquidation. This is one of the most confusing aspects of financial crises. The very assets designed to protect wealth sometimes fall during the early stages of instability. History has demonstrated this pattern repeatedly. But there was another layer to the story that analysts were beginning to investigate. Deep within the financial system exists a market that rarely receives public attention, yet it plays a central role in maintaining stability. This is the short-term funding market used by banks and large financial institutions. When banks need temporary liquidity, they turn to this market to borrow cash against high-quality collateral. Under normal conditions, it operates quietly in the background of global finance. However, when stress enters the system, activity in this market can increase dramatically. And when analysts began examining recent developments in this area, they noticed signals that suggested something unusual might be unfolding behind the scenes. These signals did not appear in headlines. They did not appear on social media. They appeared in technical financial data that only a small number of market specialists monitor regularly. Yet, historically, when those signals appear, they often precede periods of significant volatility across global markets. If those signals were indeed pointing toward a tightening liquidity environment, then the sell-off in gold and silver might not be an isolated event. Instead, it could represent the early warning signs of a much larger adjustment moving through the financial system. For business leaders, investors, and entrepreneurs who rely on stable economic conditions, understanding these signals becomes critically important. Because liquidity crises rarely remain confined to one market. They spread. They move from commodities to equities, from equities to credit, from credit to the broader economy. And once that process begins, the financial landscape can change very quickly. The real question now was not simply why gold and silver had fallen. The deeper question was whether the sell-off was revealing stress building quietly within the financial system itself. If that were the case, then the precious metals crash might not be the main event. It might only be the first signal that something much larger was beginning to unfold. At first glance, the situation appeared almost illogical. Geopolitical tensions were increasing across several regions of the world. Energy supply routes were facing potential disruption. Governments were expanding spending programs, and global debt continued to climb to levels never seen before in modern financial history. Under these conditions, precious metals normally strengthen. For decades, investors have viewed gold and silver as insurance against uncertainty. When currencies weaken, when inflation rises, or when geopolitical tensions increase, capital traditionally flows toward these metals. But the current market behavior appeared to contradict that pattern. Gold was falling, silver was falling even faster. This contradiction created what many analysts described as a geopolitical paradox. On one side stood the traditional narrative supporting precious metals. On the other side stood the price action suggesting that investors were moving away from those assets, at least temporarily. To understand this paradox, experienced market observers began examining a principle that has shaped nearly every major financial crisis in modern history. That principle is simple. During periods of severe financial stress, liquidity becomes more valuable than protection. In normal economic conditions, investors focus on protecting wealth. They allocate capital into assets that preserve purchasing power over long periods of time. Gold, silver, and other hard assets often play a role in that strategy. But during moments of sudden financial pressure, priorities change. Institutions begin focusing on survival. When banks, hedge funds, and large financial firms face immediate liquidity demands, they are not thinking about long-term protection. They are thinking about short-term obligations. Loans must be repaid. Margin requirements must be met. Collateral levels must be maintained. If those obligations are not satisfied quickly, the consequences can be severe. This shift in priorities forces institutions to sell assets that can be converted into cash quickly. And ironically, some of the most liquid assets in the financial system are also the assets many investors view as the safest. Gold and silver fall directly into this category. They trade in deep global markets. They can be sold rapidly through futures exchanges, over-the-counter markets, and exchange-traded funds. Large positions can be closed within minutes. Because of this liquidity, precious metals often become sources of emergency capital during systemic stress. The pattern has appeared repeatedly throughout modern financial history. When the global financial crisis began in 2008, investors initially expected gold to surge immediately. After all, banks were collapsing, credit markets were freezing, and confidence in the financial system was deteriorating rapidly. But the opposite happened. In the early phase of that crisis, gold declined sharply. Not because investors suddenly lost faith in the metal, but because institutions were selling anything they could in order to raise cash. Only later, once liquidity conditions stabilized, did gold begin one of the most powerful rallies in its modern history. A similar pattern appeared again in 2020, during the early stages of the global pandemic. Markets across the world entered a sudden and violent liquidation phase. Stocks collapsed. Energy prices fell dramatically. Credit markets tightened. Even gold experienced a short-term decline during the initial wave of panic. Yet, once central banks responded with large-scale monetary intervention, precious metals began rising again. These historical precedents offered an important insight into the current situation. Short-term price declines do not always reflect long-term fundamentals. Sometimes they reflect something much more immediate: liquidity stress. In the present moment, the precious metals market appeared to be caught between these two forces. On one side stood the long-term drivers supporting gold and silver, rising debt levels, geopolitical tensions, and concerns about the stability of global currencies. On the other side stood the short-term pressure created by leveraged positions and liquidity demands. When these forces collide, price action can become extremely volatile, and volatility often creates confusion. Some investors interpret falling prices as evidence that the bullish narrative has ended. Others see the decline as a temporary distortion caused by mechanical selling. Determining which interpretation is correct requires looking beyond daily price movements. Analysts must examine historical patterns. They must study how markets behaved during previous periods of financial stress, because history often reveals something important about the structure of modern financial systems. Crashes rarely occur in isolation. They follow recognizable patterns. Leverage builds slowly during long bull markets. Investors become increasingly confident, positions grow larger, and risk levels expand quietly beneath the surface. Then a triggering event appears. It may be a geopolitical shock, a sudden shift in monetary policy, or liquidity disruption within the banking system. Once that trigger appears, the system begins unwinding. Positions shrink. Volatility increases. Markets that once moved independently begin moving together. This process does not always mean a permanent collapse, but it does signal that the financial system is undergoing a period of adjustment. The precious metals sell-off might therefore represent something more complex than a simple market correction. It might be the early stage of a larger cycle, one that has appeared before during other periods of global financial tension. To understand whether that possibility was realistic, analysts began examining historical precedents where precious metals experienced sudden crashes. Because history contains several moments when gold and silver fell sharply, only to later reveal that those declines were part of a much larger financial transformation. When analysts attempt to understand unusual movements in financial markets, they often turn to history. Markets rarely create entirely new patterns. Most of the time, they repeat structures that have appeared before, sometimes with different causes, but often with remarkably similar outcomes. For gold and silver, several historical episodes provide important insight into what may be happening now. One of the most instructive examples occurred during the global financial crisis of 2008. At that time, the world's banking system faced one of the most severe liquidity shortages in modern history. Major financial institutions were collapsing, credit markets were freezing, and governments were rushing to prevent a complete breakdown of the financial system. Under such circumstances, many investors expected gold to rise immediately. The logic seemed straightforward. If confidence in banks was declining, then assets outside the banking system should become more valuable. But the initial reaction of the market surprised many observers. Instead of rising, gold began to fall. During the early stage of the crisis, investors were not primarily focused on protecting their wealth. They were focused on obtaining liquidity. Hedge funds were facing redemptions, banks were adjusting balance sheets, and traders were closing positions across multiple asset classes. In order to raise cash quickly, institutions sold assets that could be liquidated easily. Gold, despite its reputation as a safe haven asset, was one of those assets. However, once the initial liquidity panic began to stabilize, and once central banks began injecting large amounts of money into the financial system, the direction of the market changed dramatically. Gold began a powerful multi-year rally. From the depths of the financial crisis, the metal eventually climbed to new historic highs as investors began reassessing the long-term consequences of massive monetary stimulus. Another important example occurred in 2011 within the silver market. Silver had experienced a powerful speculative surge. Prices were rising rapidly, investor enthusiasm was expanding, and leveraged trading activity was increasing throughout futures markets. At one point, silver approached levels that had not been seen in decades. But the rapid rise created structural fragility. Exchanges began increasing margin requirements in order to reduce risk in the system. These increases forced traders to deposit additional capital to maintain their positions. For many leveraged traders, meeting those new requirements became difficult. The result was a sudden wave of forced selling. Within a short period of time, silver prices collapsed sharply, wiping out a large portion of the gains that had accumulated during the speculative rally. Yet even that dramatic decline did not signal the end of silver as an asset. Instead, it demonstrated how leverage can amplify both upward and downward movements in commodity markets. A third example appeared much more recently during the market turmoil of 2020. When the global pandemic triggered widespread economic shutdowns, financial markets reacted with extreme volatility. Investors rushed to reduce risk, institutions scrambled to secure liquidity, and nearly every asset class experienced rapid declines. Stocks fell dramatically, energy markets collapsed, credit markets tightened. Even gold experienced a brief decline as investors sold positions to raise cash. But once governments and central banks intervened with aggressive economic support programs, markets stabilized. Precious metals soon resumed their upward trend as investors began focusing once again on long-term monetary risks. These historical events reveal a consistent pattern. First, markets experience a period of rising optimism and expanding leverage. Second, a triggering event disrupts that environment. Third, forced liquidations create rapid price declines across multiple assets. And finally, once liquidity conditions stabilize, markets begin reconnecting with their underlying economic fundamentals. The current decline in gold and silver may be following the early stages of that familiar pattern. However, there is an important difference that makes the present situation more complicated. The global financial system today is operating under far greater levels of debt than during previous cycles. Governments have accumulated unprecedented fiscal obligations, and central banks have expanded their balance sheets dramatically over the past decade. At the same time, geopolitical tensions have become more complex, supply chains have grown more fragile, and economic uncertainty remains elevated in many regions of the world. These structural factors mean that the future path of precious metals will likely depend on one critical variable: liquidity. If liquidity conditions continue tightening across financial markets, then volatility in gold and silver may persist. Investors could continue selling assets in order to secure cash and stabilize their balance sheets. But if central banks intervene, as they have done during previous crises, then the current sell-off might eventually transition into a very different phase. A phase where investors once again begin searching for protection against long-term monetary instability. At this stage, analysts are watching several indicators closely. They are monitoring liquidity conditions in global credit markets. They are observing institutional positioning in precious metals futures. They are examining the behavior of large financial institutions that often move first during periods of systemic stress. These indicators may provide early clues about whether the recent crash represents the beginning of a prolonged downturn, or simply the opening phase of a much larger financial cycle. For now, one fact remains clear. The sudden collapse in gold and silver prices has forced investors to confront an uncomfortable reality. Even assets considered safe can experience violent declines when liquidity pressures enter the system. And when those pressures appear, they often signal that something deeper may be unfolding within the structure of global finance. What happens next will depend on how the financial system responds to those pressures and whether the forces driving the current volatility are temporary disruptions or the early warning signs of a much larger transformation in the global economic landscape.